In part 1 of this video, I explained how bad mortgages have created mortgage-backed securities that no one wants to purchase. And some banks are going bankrupt because they cannot sell the mortgage-backed securities. Some people think that if too many banks go bankrupt, then it will cause a domino effect. Here's how it might happen. First, more banks go bankrupt because they cannot sell the mortgage-backed securities. If enough banks go bankrupt, then the insurance companies that insured those banks will go bankrupt. Other banks that have not yet gone bankrupt but loaned money to the insurance companies and the already bankrupt banks will then go bankrupt. But the effects of bankruptcies in the United States will reach beyond the United States borders. Foreign governments and foreign banks have loaned money to U.S. companies, and foreign insurance companies have insured U.S. companies. All of these foreign companies and governments will be hurt, and some will also go bankrupt. Bankrupt companies leave unemployed workers. With less tax revenue, governments have to raise taxes to pay for services. As more banks fail, interest rates rise. Higher taxes and higher interest rates cause more layoffs. As you can see, the world's financial institutions are connected. U.S. banks go bankrupt, causing insurance companies to go bankrupt, which hurts foreign companies, foreign governments, and foreign banks, which causes more banks in the U.S. to go bankrupt, causing more insurance companies to go bankrupt. Once the spiral effect kicks in, all of the major financial institutions are at risk for bankruptcy. If the meltdown happens, then it started with bad mortgages. Remember, the bad mortgages make it difficult to know how much the mortgage-backed securities are worth, so no one wants to buy them. Some banks will fail because they run out of money, and if enough banks fail, then it sets off the domino effect. The government's solution is to prevent the domino effect by giving massive amounts of money to the banks. Even if we assume this would prevent the domino effect, it doesn't fix the underlying issues: bad mortgages and mortgage-backed securities that no one wants to buy. We need a plan to fix the root of the problem: bad mortgages. If we fix the bad mortgages, then it will be possible to measure the value of mortgage-backed securities. If people know the value of the mortgage-backed securities, then they will start buying them. If people are buying the mortgage-backed securities, then less banks will run out of money. Since less banks will fail, the domino effect will not happen. How do we turn bad mortgages into good mortgages? The following is a simple plan that could work. There are other plans that would also work. The key to fixing this crisis is to turn bad mortgages into good mortgages. Recall that some bad mortgages are bad because the homeowner is not able to keep up with the monthly payments. We should make a rule that if the homeowner is paying 35% of her monthly income towards her mortgage, then the bank cannot foreclose on the house. The bank can still report to the credit agencies that the homeowner is behind, but no one loses their house. Other mortgages have ticking time bombs. Allow the homeowners to go to court to remove the ticking time bombs from the mortgage. Courts could restructure the loan. The monthly payment would be 35% of the homeowner's income. The interest rate would be the Freddie Mac average plus 1%. This is not a sweetheart deal for the homeowner, so they will only do it to avoid the ticking time bomb and if they were unable to refinance the loan on their own. Once the bad mortgages are turned into good mortgages, it would be possible to figure out how much the mortgage-backed securities were worth. Each bank that issued mortgage-backed securities would audit a sample of their mortgages. The results would be public, and then investors would know how much the mortgage-backed securities were worth, and then they would start buying them again. Any plan that lowers the principal of the loan must lower it in a predictable way. Otherwise, the audit of the mortgage-backed securities will be difficult or impossible, and it will be hard for investors to know the value of the mortgage-backed securities. We should also make it easier for homeowners to sue for fraud and predatory lending by awarding attorney's fees to the homeowner if she wins. Or, if we are worried that this will encourage frivolous lawsuits, make a rule that the loser pays the attorney's fees. Some of the sellers of mortgage-backed securities knew that they had fraudulent mortgages in their portfolio. We should make it easier to sue these sellers by awarding attorney's fees. Again, this is just one plan that could work. There are other plans that will solve our problems. We need to turn bad mortgages into good mortgages, and we need to make it easier to sell mortgage-backed securities. If we are going to find a real solution, then more people need to understand this problem. Share these videos with your friends. Congress needs to know what you think and what you want them to do. Whether you support this solution or not, you should call your representatives and tell them what you think.